Hey, everybody, welcome back to another episode. I'm excited. Today, I've got Mathew Owens in the show. Guys, this is the real OG. Listen to this guy's resume for a second. So, he is the owner of OCG Properties. He is a certified public accountant over the last 20 years. He's bought, renovated, and sold over 1,000 single family homes. He's acquired and operating value add multifamily properties. He's a private lender with over 35 million lent in multiple markets across the United States. He's raised over $150 million in private investor capital, currently owns over 1,450 units, and he's got 15 plus years experience in property management, taxation and auditing, and real estate and experience that includes syndicated investments, performing and non-performing notes. We're going to get into that today for sure. Single family, multifamily properties, and private lending. Matt, welcome to the show, my man.
Thanks, man. Can you see the black eyes from all that stuff that I've done, still showing up, or is that
I
just
can see
wrinkles
right there. I
now?
can see the emotional scars too from it because I know
Yeah, there
you've
you
got a
go.
lot of those buried underneath. Man, you have such an extensive resume, and there's so much to dive into here today. For those that don't know you, can you give us like a quick, background story, how you got started, and how's your business evolved to this massive machine that it is today?
Yeah, absolutely. Thanks so much for the intro. Really, really appreciate it. So I'm a CPA. I live out in Southern California, out in communism, I call it. But I'm out here in Southern California, and what I was working at multiple CPA firms, and honestly, just I was good at doing audit and tax, and working on a lot of real estate clients and other small businesses, seeing internal controls. But after a while, it started to become monotonous, and who would have thunk tax would be, monotonous and boring, right? So at the end of the day, I was looking for something else, and I was bored out of my mind. And I stumbled across real estate. I actually went to some real estate classes and things like that, and I was immediately hooked and is super interested. It may have had to do with the fact that I watched or I just read like Rich Dad Poor Dad, which is I'm going making the wrong type of income. I got to either be running a business so that I can be the business owner, or have investment income instead of being self-employed and doing that, because it's hard, right? And we still work really, really hard as a business owner to set up the right systems and tools. But at the time, I was like, how do I get out of this? And I'm limiting myself from what I can do here, and I want to create this financial freedom in my life. Otherwise, I feel like I'm going to be a slave to this job, and so I got to focus on creating cash flow in different ways and building assets that create that cash flow instead of constantly trading time for money, right? And
Right.
that immediately in my head like stuck. And I remember thinking, oh, I'm gonna have plenty of time to go to the gym all the time, and have plenty of time now. Of course, 14-hour days later for a period of time, of course, while I was growing this, was the reality behind it, of course, just like any business owner deals with. And so I ended up getting my first deal under contract, and I quit my CPA firm job, and this was in 2006. So I was a real estate genius for about a year and a half before I got my ass handed to me by the real estate crash, and punched in the face really, really hard. It was probably the best thing that ever happened to me, though, because at the end of the day, um, I was able to get extremely strong from that. My ego was destroyed. I thought I was dope because I had a 790 credit score, and had a bunch of empty credit card lines available to me, and had like I thought I was doing good as a business because my bookkeeping was done, right? And so and that's the furthest from the truth, right? Of course that's important, but one of the million things that you got to do. And so that's really was the start of my story, is doing that. I did everything wrong in the beginning. Got an office at the World Trade Center in Long Beach on the 23rd floor, looking over all of Long Beach. Was beautiful. Sold a lot of houses. We were starting to flip 5 houses a month consistently, doing that. And right after quitting, and then when we lost everything, I ended up taking out 200 grand on my credit cards to pay my investors back. And when I did that, I didn't realize it at the time. I just was like, oh my God, these are friends, family, people that I know. I got to be able to get their money back. And once I did that, a lot of them reinvested with me, and helped me to get started again and keep going, because I just went and hunkered down, no office, just working from home type of deal, and started doing joint venture flips with investors, where I'd make a $5,000 fee for acquisition and rehab management, and then we're going to go out and go flip that house, and I'm going to use investor capital to do so. And we started doing that, and I started seeing, oh wow, 5 grand keeps the lights on here. That's, great. Now, how do I go through and do more of these? And so I started doing about 5 of those a month consistently, because, you know, at that time it was easy to buy houses all of a sudden, So, and then I had to get creative on how to sell them. And we were selling some, and then some were taking longer to sell, because remember, this is, 2008 through 12 was the downturn of the market. And so I had to put new tools to my tool belt. So I started learning seller finance strategies and started doing seller financing of these properties, these turnkey single family homes that are rented out at like 7 caps or 8 caps to people's IRAs and 401ks, as well as to 1031 exchange investors. So I'd package deals together, and I still do that to this day, where I help investors with 1031 exchange replacement property by hitting their sale amount, hitting their loan amount they got to replace, and hitting their down payment requirements for the 1031. And so we structure those types of deals, and that's when I started to fall into the financing world in that case and start to do that. And then around 2017, after going through that, starting to sell, starting to see the up market, I started having more capital than I could use for my own deals. And so I started lending the capital out, and that turned into a $35 million lending business now, that we are, we make interest rate spreads. We have our own fund that investors invest into, and then we use private investor capital on promissory notes and things like that. And so that's kind of how we transition into the lending space. Along the way, I transitioned a lot away from single family homes into multifamily, because the bang for your buck was just huge, or bigger development type deals, right? Versus just one single family at a time type situation. So that's kind of how it grew. And now I've raised a little bit over $150 million for real estate. And we do a lot of different types of transactions, like mobile homes and debt in different ways, and different businesses that we invest in, and still do single families as well, because we have a good machine going, and that type of thing. So it's a lot more fun than doing accounting and, audit work at a CPA firm, right? So
Yeah, you've got your hand in everything, and I'm curious if like one of those strategies is something that you're gonna pivot towards and do more of. If you see some differentiation before we go there, walk us back 2008. Right now, there's a wave of foreclosures happening. There's a lot in the commercial real estate sector, specifically. It's definitely getting the most attention, and it's kind of this
mhm,
like not so subtle. I want to use the word gentle, but maybe not so gentle. I don't think it's having the repercussions that like 2008 did on the economy, but
right,
there's a lot of CRE investors that are being reminded that hey, market corrections are still out there. We had this
right.
black swan event with interest rates. I know that the single family world is getting affected as well. We're feeling that on our end with a lot of houses that we're building. You did something in '08 that was extremely rare, which was you paid your investors back. And you say that that was the seeds of success that helped you develop and really bounce back from that failure. How did you go about doing that? Like, what was that like when I'm assuming you're flipping these houses, all of a sudden, all of your buyers dried up. You transitioned to this seller financing strategy in order to obtain funding to be
Mhm.
able to continue doing these flips. You've got these limited partners that are part of the deal. What was like your structure with limited partners back then? What happened to cause the losses, and how did you go about paying them back?
So we basically, in the beginning, we were borrowing funds, as we called it, the Be the Bank program. I still call it that to this day. And we were borrowing funds from private investors, and we were buying these properties and immediately flipping them. Our margin wasn't very big at the time, like it is now, because we didn't even know how to market yet. We were finding properties from other wholesalers and things like that, and picking them up. And so the loan to value was a little higher than I would have liked. But when the market stopped, we were buying them, renovating them, tenting them, and immediately reselling to other investors that would then, with seller financing, and then they'd immediately go refinance and pay us off as a rate and term
Turnkey.
refinance, right? And so that's how we were structuring those deals. And then when we went and bought 35 of these with a bunch of investor cash and a lot of our cash, right when the lending market stopped, and we had already had, in the process of seller financing when none of them could get refinanced. And so we were stuck with these properties that then, with no liquidity in the entire real estate market, those properties dropped like 20 to 40% immediately overnight, because nothing that was going through was only cash sales. So on paper, no appraisals could get done during that period of time because there was no financing available for that period of time. It was a stopped market for, a chunk period of time where you're not seeing appraisals happen. And so we were like, oh my God, what do we do? Let's liquidate. And as we liquidated, we realized we were $200,000 short in addition to all our money. And I happen to have $290,000 worth of empty credit card lines available to me because I had a 790 credit score, and my whole ego was, oh, I got great credit, we're selling houses, and I'm dope, and realized, no, the market is dope. I wasn't dope, and and at the end of the day, I just took it out of my credit cards and we just paid our investors back, and then just because we were like, we can't let them lose their money. That's hours of their life. That's not money. It's really hours of their life that they spent achieving that, and so at the end of the day, that's what we did. And then we started right after that doing individual joint ventures, one investor at a time on a per project basis. They'd put up, $50 to $100,000 on a project purchase out in the Midwest or the South, and we'd go and flip that property with them and do the renovation and go flip the property with them and build in our fee structure into doing that, right? So that way we could at least keep the lights on during that time, and we're doing like 5 of those a month. And then we realized, after we started doing the lending side of things a little bit more, and we're doing a lot more flips, that we should start a fund and do the fund structure, because just the paperwork alone on the back and forth on the individual promissory notes or the
Yeah.
properties it was crazy amount of work when you're doing 5 houses a month on the flip side, and a couple $1 million a month on the lending side. It just was like too much to deal with. So that's when we started creating the fund structure and going into that world, which really opened my eyes to a much better structure for the passive investor and for the operator to deal with, right? So
Yeah, we struggle with this. So we used to do the same thing. It was promissory notes. So if we needed to go raise 300 grand, we needed an investor to do it. And it became like playing Tetris with people's money. And the
yeah,
problem arose when you're like, well, I got 270, but I don't have 300. And then you're like, well,
right, right,
someone with 300. It's like, well, I guess I'll just take my 270 and go somewhere else. Right. And so
right,
it became very difficult to keep the amount of money the investor needed to invest busy. And as a result, we do all this work to build the relationship, win them over, multiple deals together for them to just fall off and go somewhere else because you couldn't continue service them. And so we did
right,
something similar with the fund model, where it's like, hey, we now have something that is going to work for you.
right.
And that's been successful. So you've got this crazy resume, syndicated investments, performing, non-performing notes, single family, multi-family properties, fixing, flipping, private lending, all this. Have you noticed on this path that you've done with over 15 years of experience, are you gravitating towards one particular niche than another?
Yes, and that's being as passive as possible. So I want to
Yeah.
be 3 steps away from the actual house or the property in itself, so that way
Okay.
I don't have to do as much work. Because I got an 8-year-old and a 5-year-old now, and I think everybody goes through this transition period where, yeah, in the beginning you got to build your own wealth. Unless you already have a business, you're making a ton of money, on the side there, and you can invest that and become passive, automatically. Then through just investing with good operators that already know what they're doing. But in the beginning, a lot of times people need to build their wealth. And so being active is key. It also helps you become a specialist. Like after flipping 1,000 houses now, I'm a specialist at flipping houses. I know what I'm doing. That doesn't mean I still can't take losses sometimes, but
Yeah.
at the same time, I understand that model and that path and the liabilities and the limitations there and the risks associated with that, right? So but I'm gravitating towards, I really have a superpower of financial modeling, asset management, bringing teams together. And so I focus on finding really good operators and working with them as the CFO or partner with those operators in that niche where I can basically add value by bringing financial modeling, bringing my risk mitigation hat on, how to structure these deals so that investors are protected first, and that there's incentives for performance involved in these types of projects where investors get a preferred return on their money. There's a good split. There's not major problems with fee structures up front. And so I help with those types of structuring components and the management of those assets as well from a CFO type standpoint and a funds control standpoint. And then work with someone that's a specialist, like in mobile home parks, or and I also still operate and have my own team operating directly in the promissory note section, and then my single family home business where I have that up and running, where I have teams that are helping me with all of that stuff so I can be more passive. But I'm transitioning even away from that and putting all of my deals into one big fund so that way I can have one place that I buy all these assets instead of like all over the place as the deals arise, So
So it sounds like very funny. We're doing something similar. We were vertically integrated. We had an acquisition arm to go out and find it. We weren't relying on other people to bring us deals. We then created a construction company because we're like, too much risk hiring a builder, control our own costs, et cetera, mitigate our own
right.
timelines, mitigate our own risk, and the capital raising company. And it worked. It got us to a point of doing about 20 million a year. And then the system broke. And we
Yeah.
realized the same system that got us to where we are today is not what's going to get us to 100 million. And we're doing the same thing. I'm now looking for builder operators, development operators. We found one that's been fantastic, build to rent guys, where, we just want to basically still operate the acquisitions and find the deal because we love our market,
Yeah.
but not be involved in, doing the operations, just, raising the capital. Is there a particular like niche that you're attracted to now that you want to be more passive? Are you shutting down any of the the house flipping stuff, or are you gravitating more towards like the note investing? When you say that you want to be as passive as possible, what does that look like? You said operators. Are there any specific niches that you're letting go, or any that you're bringing on?
So I'm slowing down massively in the single family space. I'm putting everything into one big fund, like I mentioned, so that I don't have to do as much work. I have asset management in place on that already that's helping with that. And I'm going with an all cash investment. So I have no debt on any of that stuff, very safe, long-term type stuff. And that's more of a, set it up and then let it cash flow long-term from that perspective. But I'm leaving it open to buy more into the future if there's changes in the market that occur and stuff like that. And we'll definitely get back to your comment about the multifamily versus single family market and what's happening in the overall economy as well. But at the end of the day, I'm focused a lot more now on promissory note investing, where I can go through and create cash flow streams through that, because I like it because it's very liquid. You can actually sell promissory notes relatively easily, a lot easier than you can sell property, actually, because you're just signing a purchase agreement. You're signing assignment of the deed of trust and the collateral that it's against the property. And
Yeah.
then many times there's 6 month to 12 months notes out there. There's long-term notes too, but I like the liquidity aspect where I can sell it easy. I can go through and get a good cash flow without having to be the direct owner of the property. I have a team that manages those assets on the construction lending side and everything, so that if they're managing the construction draw process and all that stuff. And so I can not have to be the direct operator, but still help manage those processes and protect investors on that side. And my investors get that liquidity option as well, which I really love. And so real estate, especially in a value add, as you know, it could take time to get that cash flow up, even if it's cash flow investment versus a development and a flip play, right? And so development and flip plays are great because you get heavy returns, but there's usually no cash flow in the meantime, right? Even on a mobile home park, for example, or a multifamily, you have a value add period where cash flow in the beginning is lower, and then it ramps up as you do your value add and you increase rents and renovate the units and things like that.
Right.
I counterbalance that strategy with promissory notes because I get all my overhead covered with promissory notes. Every month, I'm getting a check every month, and I'm getting my cash flow coming in every single month on that without, yeah, there's headaches every once in a while. There's a foreclosure every once in a while on properties. There's things that you have to deal with on the operational side, which a lot of my team handles now. At the
Mm.
same time, going through and getting that steady cash flow stream is a second option that I would highly recommend for different investors, depending on their comfort level and their interest. Right, the cash flow piece on a property ownership, you're going to get some big tax benefits from doing that too, a lot of times. So there's tax benefits, lower cash flow, higher upside potential on property, and a longer term investment a commitment time. Right, in a promissory note, it's a set return, shorter commitment time, and more liquidity. And I like balancing these two things, because if I want to get my money out of promissory notes because some crazy awesome opportunities over here, I can pounce on it relatively easily by
Yeah.
recapitalizing over here. So that's why I like promissory notes and why I invest in them, and my focus is much more in that realm.
Yeah, and there's definitely some things that have happened in the multifamily and single family world that has really, you're seeing a lot of debt funds come to mind now. It's starting
Right,
to make sense, especially where bank rates at, where the interest rates are at. I'm curious,
right.
when you're talking about these promissory notes, are you getting uh offers from, like, let's say it's like a house flipper or something, like, hey, I got this deal, I need a loan, and you're raising money from investors and deploying that and underwriting it? Or are you going out and buying existing notes that have already been underwritten and are performing, and you're just acquiring that?
Both. So
Both.
most of the time I can usually, if I'm buying it or if I'm lending on it myself and being the direct originator, then I'm usually getting around 12% interest rates on my money if I'm doing
Yeah.
that, right?
Okay.
And the thing is, whether you're buying it or originating, you still got to do the full underwriting and all that stuff to know that it's a good note, because a lot of times it's very difficult to know what the due diligence of that originator is. And there's so many checks and balances that have to go into. You should see our note spreadsheets. They have like 30 metrics or 40 metrics of every little piece that go into that, like how much did the borrower put down? How much of a percentage of that? What's the as is value compared to the appraised value?
Huh.
Like there's like all these little metrics, what the rehab hold is. We sometimes we have an interest hold where we hold back the interest too. So
Yeah.
all of those things we have to put in place. And so we do both, and I like both. I'd much rather go and buy notes, because working with borrowers consistently, going through and doing that's a lot of work, right? You get paid points and fees for doing that, though. You get compensated for that extra work, but there's still a lot of additional work that goes into that project versus just taking a package that's already done, where you don't have to communicate with the borrower anymore. You don't have to be back and forth, and you don't have to handle servicing or problem resolution, because they usually do that. And then, we hold it. So, just like my investors invest with me and rely on me to be the operator, I do the same thing across the board in many instances, but there's a lot more homework that I do most of the time than even my private investors, where I'm really in the interest of protecting everybody involved, because in my investments, I don't get paid unless my investors hit their preferred returns, period. And I
Mm.
usually go lend at 12 and then borrow or utilize my investor funds at like 8% on
Yeah.
those funds. So,
So when you're either underwriting it yourself, right? You're dealing with the borrower directly, and you're also buying existing notes. Talk to us in the lens of an investor. What's the difference between this type of investing in regards to risk, versus typical equity investment in a multifamily situation? You said some notes out there. You said, 12%, it's a promissory note.
right,
And I think a lot of people, especially accredited investors in the syndication world, are like, well, I'm getting like 18+% IRR in this
yeah,
multifamily deal, et cetera, et
yeah,
cetera. But there's some, in right now, the bank risk because of refinancing, having to refinance or sell your asset, is what's
right,
causing this wave of foreclosures. So there's so much debt risk
right.
that is causing this $2 trillion tsunami. And I know that this is going to play into your strategy here on how to mitigate risk.
Absolutely.
Maybe speak to that a little bit.
Yeah, absolutely. So, there's different types of funds out there, for example, that invest in debt. Some of them, like ours, we have no underlying collateralization of our paper. So we have 100% equity against secured against the property at an average of 65% of the value of that asset, right? So I'm in a very good equity position on those assets. And then there's other debt funds that will do the same thing, but then they'll go use an outside bank to leverage the paper, and they might sell off 50% or 60%, or sometimes I've seen 90% of the paper off, which makes super high returns for the operator and sometimes super high returns for the investor. But now they're technically in second position to that bank's money, and they could lose there. So you can make a higher return. It's just a matter of of the risk there. And I don't like that risk because I went through 2008, and I'd rather just do 100% equity in that
Yeah.
situation. So there's that risk. You have that 65%, leverage return. That's an interesting, play, because you have 100% equity, right? That's a totally different risk level than doing, a value add multifamily. Now, in a value add multifamily, it depends on the deal where the risk really lies, right? So in a value add multifamily, normally you're getting underlying first position debt, and then you're putting equity in place. So investors are in second position. They're getting a higher level return. This is super customary for the space. And the risk level depends on how much that property cash flows, for example, based on the cost. So if you're making, 130, 135 plus percent on the debt payment, you're doing really good. That's the debt service coverage ratio. You're in good shape to be able to cover the debt without a problem. So there's the risk of the value add of the operator that's doing the work, right? There's the risk of the first position debt. You're now in second position to that, as far as equity goes compared to the loan. And then on the back end, when you do your value add, you have that refinance risk, right? And what is that rate and term going to be like at the end of that 3 years or 5 years when you're done with your value add and you're trying to refinance that property? And so, like, one of the deals that I just invested in was a 172 unit mobile home park, where we're adding 52 new units to the park, and rehabbing another 26, and we're ending it up at a 13.8% cap rate at our cost. And so we were able to put the refinance debt at like 9%, so much higher than what current is. And we put
Yeah.
the exit cap rate at 8.25% instead of what market is at 6.75 right now, as if the market crashed and the deal still worked. So it's a matter of analyzing each one of those individual deals for the risks of the refinance debt, and what happens if rates rise again or the terms get worse. What happens if, cap rates, get worse, and all of a sudden your property value is less? Are you break even? Are you making money still? Are you still happy with that deal, even if the whole market crashes? Because especially in the commercial space, like you said, there's some turmoil out there on the lending market right now. Banks took a major hit recently, and they have liquidity issues themselves. And so a lot of these smaller banks that used to fund 40% of the lending market on the commercial side are falling out, or at least that's my understanding of it.
Yeah.
And so I'm not intricate to all the details there. This is just the stats that I'm hearing, and reading about. And so from that perspective, there might not be as much refinance capital in 3 years, for example, and the rates might be higher because there's less supply of capital available for the same assets. But I think a lot of that correction has occurred already on future purchases, because we've already had the rate increase, or a big chunk of rate increase. We're starting to see it even out. It may even come down, especially leading up to this election year and everything. Right now, usually things get better and more peachy because they want the economy to look better, even though there's still some
Yeah.
risk out there, and you got to be really careful. And so that's what I think you need to understand as far as the risk differences. Each deal, you got to look at each one individually, right? You can't just go through and say, hey, this commercial is all this has this level of risk, and debt has this level of risk. It depends on the deal. And I actually personally like development deals and things like that, because, like, for example, with the 172 unit mobile home park we just did, because we're adding so much value, which is a heavy lift, and you got to have a good operator that can do that. We're at a very, very good loan to or cost to the new value of the property after the valuation, right? So if
Yep.
we're at a 13.8 cap rate, that's a lot of built-in equity that we just created to weather pretty much any storm.
Yeah.
So that's what makes me feel a lot more comfortable with value add plays and development plays, because I'm adding so much equity to that project.
Yeah, you just spoke to two things that we're having to incorporate. Like all the bank financing just disappeared for development loans, right? If
Right,
you're just
right.
doing strictly horizontal work, then like you're not getting a bank loan, which has required us to do 100% investor equity, which has it's worked out. We do less deals, but again, you've removed the bank risk. And that's what I like about your promissory notes that you're doing is you've removed that bank risk where if you're a limited partner and you're investing in a multifamily deal, you're buying equity and you're getting, a 20+% IRR. If something goes wrong, the bank's getting that property and you're probably not getting your money back. And right. And as an
Right.
investor, capital preservation should be your number one priority, not return on capital and figuring out return of capital, how you're going to get it back. And so with your strategy here, I like it because worst case scenarios, you guys get the property. Right.
Right,
It's
right.
downside mitigation. You're mitigating your downside risk. What kind of returns have you been able to see investors receive in the past performance of these promissory notes that you guys are doing?
So it depends on how much capital they bring to the table. We have a tiered system that occurs, so anywhere between 8 to 9, sometimes 10% if they're bringing us a significant amount of money there. And it's a matter of how much money we can make on our spreads to make it worth it for us on the back end there. I want to make at least a couple percent spread on the capital, and then every
Yep.
once in a while we have headaches to deal with, or usually we don't take a whole lot of losses, but there's headaches that you have to deal with in the meantime. And so at the end of the day, that's usually what I'm seeing in the promissory note arena. Unless you go start to leverage those loans, I'll give you an example. I did a loan inside my own 401k for $500,000 to another investor at a 14% interest rate. It was a 14% flat. There was no fees or anything like that. It was just flat rate, right? No points or anything like that, or even loan fees. And then my 401k, and that was at 65% of the market value of that property. Then my 401k borrowed or utilized or sold off $450,000 of that note. Didn't even borrow it, just sold it off for for an 8% interest rate. And so on my 50 grand left in the deal inside my 401k, I was making the difference between the 14% and the 8% interest rate on the entire thing, which is a 68% return on investment. So this is why these funds will collateralize these loans, because the returns shoot through the roof. But then at the same time, the investor is at risk. Like my 50 grand was in second position to my private investors' capital at 450 when they're at a 55% loan to value. I also had the capital if I needed to go pay them off, or had a solution for that if that was an issue. You can always sell promissory notes to pay off your underlying debt, or put reserves in place for any potential haircuts or losses that could occur there if you leverage that. But that's why they do it, because it's like shoots the returns through, but the risk also goes up massively too. You could see.
All right, so I want to replay that for a second. So
Sorry.
you borrowed, half a million, whatever it was, from
Yeah.
your 401k, and you lent it to an investor at 14%. So you are now in first position on this property, and you're collecting 14%. And then you collateralized that and said, "Hey, I'm going to go use this position to go borrow money and
So
lend it on another project." Is that
so
right?
so what I did is my 401k had $50,000 in it left that wasn't invested at the time.
Okay,
And
got it.
my 401k owned the loan. My 401k was the one that did the loan, not me personally. I didn't borrow it
Got
from
it.
my
So it's got
401k.
some equity per se. Hey, look, it's got this debt position of 450 grand plus 50K left in it to do whatever with.
Yeah, so what I did is I was about to go loan a $500,000 loan. I funded $50,000 and my private investor funded 450,000. And then on
Okay.
the promissory note and the deed of trust, I created that promissory note and deed of trust in the name of my 401k, and then my 401k sold off 450,000. They didn't borrow it, they sold it off and said, now you own $450,000 of this promissory note, and my 401k owned the rest, including the spread, because I sold it off at an 8% rate and kept a servicing spread or an interest rate spread on that money. So yeah, really cool stuff. When you start to learn the math, you're like, ooh, that's interesting. But you want to be careful, right? Like I'm not going to go do that with $1 million necessarily when, I might do it at a smaller scale. I don't want to leverage to that degree unless I'm still on equal footing with my private investor with the capital, where we each
Right.
take our own haircut if there's a
Yep.
problem or something like that, right?
You've
So
got the ability to cover it in the event that you've got a liquidity issue.
exactly, exactly.
100%.
So fun
Dude,
stuff,
this
the
has
math.
been awesome, man. This, hope you guys are listening to all this and replaying it, because this is really, really great strategies on how to preserve wealth from a guy who's been doing it for over 15 years and paid back his investors at one of the, arguably worst real estate crashes in history. Matt, if people want to learn more about you, learn more about investing with you and options, where should they go?
You can go to my website at MathewOwens.com with one T in Matthew, MathewOwens.com. And if you guys want, I have a free 200-point due diligence checklist on my website that you guys can download for free. It's the one I use to go over all of my syndication deals when I'm investing with other people and I'm, looking to invest with other operators. So I hope it helps you guys. Again, that's MathewOwens.com. Thanks so much.
Awesome, Matt. It's been a pleasure having you. Thanks for coming on.
Thanks. Appreciate it.